Let's talk about BIRLA Frontline, which is essentially a large cap and a mid cap fund. When I look at the portfolio, I see that there's an overweight on capital goods. Is the overweight on the sector largely focused on some of the select large cap names which are marquee or well diversified businesses like L&T or BHEL, or is it a broad call across the sector?
Yeah, I think the way the Frontline Equity, which is one of our flagship fund, which has got a size of roughly about 3,000 crores. The way the portfolio is constructed is it first hugs actually the BSE 200 index weight. The index weight is about 6.8% for capital goods sectors, and here it has a weight of about roughly about 9%. Within the capital goods sectors, as you rightly put it, stocks like L&T do part of the portfolio, is roughly about 3.5 or 4% of our portfolio. There are certain other companies in the same space, which are multinational companies who have a strong presence in India, such as Cummins. It's also part of the portfolios, which has got nothing to do with more of the capital goods sectors, which currently we are facing in India, especially related to the infrastructures.
So well diversified.
Well diversified. That's why I think, as I mentioned earlier, that ultimately the success will rely on how to actually choose the stocks in that specific sectors, and which would have relatively a lower downside risk. At the same time, earnings of these companies would just not depend only on India story, also derives benefit out of some of the global presence what they have.
Okay, when I look at your top 10 holdings in this fund, I see names like Reliance Industries, Infosys, Bharti.
Yes.
In fact, from the top 10, the ones that have generated most returns have been the private banks, not so much of the leaders from the other sectors.
Sure.
My question to you is, why do you still keep your conviction with these stocks? Is it purely because of the mandate of the fund? And secondly, how long is the duration for which this conviction holds in a particular stock?
The top 10 stocks we generally put into those stocks where we have a very high level of convictions, and we need to also have an exposures because they are large in nature, and being the large cap, they also participate in the market. Except one or two stocks could move from top 10 or below top 10, but 90% of the stocks will stay invested on 90% of the stocks for a very long period of time. The way we have seen in the last many number of years, generally the top 10 of the portfolios, 90% do not change even beyond 2-3 years.
Financials is your top holding in this fund, followed by energy and technology.
Yes.
The consumption themes, where returns and alpha has been generated over the last 6 months, are lower in the portfolio, whether it's autos, whether it's FMCG or even pharma. Why is that? In
some sense, financials do capture actually the consumption story. I think they participate both in the infrastructure as well as in consumptions with respect to being part of the funding of the whole segment. At the same time, the consumptions has to be again divided into two parts, which is, of course, as you rightly put it, auto also is part of consumptions. But if you look at all our portfolios, there are a lower weight on the two-wheeler, which largely has got very stable earnings, stable outlook, and the fundamentals are far superior to some of these automobile segment, which is in the commercial vehicles and passenger car segment. At the same time, within the automobile space, we have a fairly large exposure to the commercial vehicle sales, commercial vehicle companies, not just because in the commercial vehicle sales in India is happening much better, it's also because of some of this global revenue that is coming into the companies is also far better. So that's the way we have pushed in the portfolio. Okay, the next fund is BIRLA 95. It's a hybrid fund, so there is allocation to debt and equities. Exactly. But PSU banks, purely on the basis of value, do you think they are an attractive opportunity right now? The segment again has to be looked at the way I think how the PSU banks are being managed by various set of the people who are involved actually in the operations. Some of the large cap names, as I mentioned, that they are now becoming attractively valued, and valuation wise somewhat getting attractive, and also is the price reflects some of the future potential negatives also could come. So that means we need to, of course, play that game as well, and that's the way we are positioning the portfolios by increasing exposure to the PSU space to some extent in the recent past. How often do you rebalance this portfolio, and what is the criteria for rebalancing it? Because there is exposure to debt as well. The rebalancing, of course, is almost continuous. At any point of time, the equity exposures cannot go below 60%. So the rebalancing comes only to the extent of from 60 to 70 or 75 or 75 to 60. But at all point of times, as the portfolios, we remain invested to the extent of about 65% in equity. And where do we differentiate on the overall portfolio constitution in terms of where do you pick your stocks? Whether you want to stay in large cap or want to stay in the mid cap. And Birla Sun Life 95 is largely focused on stock pick investment approach, which is coming from the in the mid cap space. So that's why I think we brought in the success in Birla Sun Life 95 in terms of generating return over a longer term.
Right. The next fund is BIRLA Dividend Yield Fund. I'm seeing auto, FMCG and energy stocks being primary in this portfolio, having a large overweight. Why is that? And also, why don't I see too much exposure to healthcare? Because this is a fund which focuses on mid-cap companies, and there are a fair number of opportunities out there.
Yeah, that's interesting observations what you had. FMCG companies, if you look at the business, they are largely high free cash flow generating companies. The dividend payout has been very high, and as a result of that, they also offer a very high dividend yield from the investment opportunities point of view. At the same time, within the pharma space, the pharma again has been divided into two parts, which is in multinational companies and domestic pharma companies. And the pharma companies also do invest actually in their own business at all point of time, from the point of view generating the future, the revenue potential. In that sense, they don't fall in that list of high dividend yielding companies. And some of the other auto companies, it's a dividend yielding stocks, so largely is coming in the two-wheeler space, not coming from the four-wheeler space. And if you look at the portfolios, largely skewed towards the two-wheeler companies. And that's the beauty of this fund, where I need to, of course, look at companies only of those who offer dividend yield, which is more than 2 times 760. That itself brings in a lot of filters.
Okay, you also have exposure to DVRs. Now, as a product, it's done well in the market. We've seen a fair amount of price and volume participation for DVRs. What makes you choose a DVR over the underlying stock when you're exposing yourself to a product like this?
Of course, first and foremost, whether it is a DVR or the share with the voting rights, I have to look at whether I should own the stocks first and foremost in a portfolio, which is nothing but taking a bet on the company on the basis of the fundamentals of the business. Then next question comes actually, why should trade at a discount? The discount determines should I jump my gun in terms of owning the stocks in the portfolio. And as you rightly put it, telco DVR falls in that space. And why should it trade at a 40% discount or 50% discount? At times it's about 35% discount. The global standard for non-voting shares is roughly about 20% discount. And India is one market where it trades at a really large discount. So at the same time, so the question of course comes is whether the discount could narrow to the extent that's prevailing in the global market. And that in my belief is it's a function of the market sentiment. If it's a bull market, the discount could narrow further. If it's a bear market, because of the lack of liquidity and also lack of participation that's coming from most of the fund managers who participate in the market, they would prefer to always something which is more liquid than the liquid. So that creates some kind of the premium expansion, the discount premium expansion. But at this point of time, as you rightly asked, it has done well in the last 6 months or so.
BIRLA Mid Cap is the other fund. Now, when we look at the portfolio there, while you have exposure to FMCG and healthcare, IT, where mid cap IT stocks have done fairly well for themselves as an opportunity set, the exposure is low. Why is that?
The IT as a space depends largely on some of these global happenings. That's why I think where do you actually take a bet? Is it large cap or versus mid cap?
So you're more bullish on large caps than mid caps?
Exactly. The relative risk actually in the mid cap space, especially in a global volatile environment, is higher. So that's why though we do have exposure in the mid cap IT space, those are more stock specific, but they may not be matched up to the weight that is prevailing actually in the index.
Okay, some of the other names from the FMCG space, I see names like Marico, Cadila Healthcare, Bata India, consumption themes largely, and also some mid-tier pharmaceutical names, Divi's Labs, these are also part of the portfolio. Yes. Where do you draw the value versus growth trade-off in these stocks?
I think the whole success lies in terms of picking up stocks which provides very high visibility on the future earnings potential. And some of these names what you just took do have such kind of a potential in terms of delivering high growth from the shareholders' perspectives. And that's where they, of course, are figuring in the portfolio. But if I look at that stocks exposures vis-a-vis the sectors, they may even outside the index. And that's why I think we put our bet in terms of identifying stocks which could be probably unique to us, but not part of the index, but can deliver alpha in the portfolio.